Ewald, I mean, we're seeing continued pressure coming through into the property markets, and some analysts say that this is pretty much going to be the name of the game going forward. Is that your view as well?
Definitely, Leonie. I think we're not far out of the woods yet. The household sector is still very highly indebted. We're looking at debt levels, debt to disposable income levels of 78%. The interest rate cuts that we've seen from 2008 to 2009, the 550 basis points, have started to work through the system. So, you know, the 18 months that those interest rate cuts are effective have started to thin out. And with that thinning out, house prices are under pressure once again.
Well, that said, we are doing far better than what we were a couple of years ago, David.
Absolutely, Lenny. And actually the market is moving into a more exciting phase, I'd say. I think that we have seen depressed pricing going forward. But I think we also need to compartmentalize the market into different values of houses. Because the entry-level homes or the lower value homes, the market has been a lot more stable from our point of view. And there's been a lot more efficiency in trade, which would be buying and selling of those homes. And again, the top end of the market seems to have been more severely hit.
Would you agree with that, Ewald, compartmentalizing the various parts of the economy and, of course, just looking at what is moving and what isn't moving at this point?
Definitely, I can definitely support Dave's view on the market. If you, we break down the market into four price bands, and the lower or the affordable segment definitely has a lot going for them. As income pressures come in, there's a lot of people moving from middle segment lower. There was a lot less oversupplies created in that market during the boom time. I think that was mostly in the sort of middle segment. And lastly, if it's more credit driven, the effect of interest rate cuts will definitely benefit them a lot more.
I mean, if you look at the reports as well, you know, we keep talking about oversupply in the market, very little demand. So you're alluding to the upper end.
Absolutely, because actually if we look at the lower end, the propensity of the banks also to grant funding at the lower end of the market is a lot greater than the propensity for them to grant it at the top end of the market, because there you've got the loan to value barrier, and the equity requirement for the buyer is substantial. You know, that the buyer has to put in 20 or 30% in order to acquire the property, and because of the value of the property, that could be a large sum of money. But the banks are more amenable to granting 80, 90, 100% bonds at the lower end of the market.
Well, if house price inflation remains relatively subdued, some would, beg the question, should I be buying a home right now if I'm not going to see an improvement in the value of the home down the line? Ewald, is that something that we're going to see coming through as a trend in South Africa?
I think a lot of people are, at the moment can't afford, or they can't get past the credit requirements of banks. So it's definitely very difficult for new entrants to come into the market. But there's always opportunity. Even in bad times, it might be a good idea for a first-time home buyer to start participating in this, and perhaps take a bit of advantage of these oversupplied conditions where there's very little demand or very little competition bidding on a house.
Well, it really all depends on how long that's going to last.
Absolutely. And I think if we look at the stats at the moment, if we look at how low interest rates are and the potential of further declines, and we look at the supply and demand factor, you know, limited new housing is coming to the market as a result of the current oversupply. So it's not going to take very long for the market to correct. And I don't think that there's a wrong time or a right time to buy. There's a right opportunity or a wrong opportunity within the market. And if the product is priced well relative to the market, it's always a good time to buy if one can afford it.
We'll be looking at the house price inflation in October, 4.4%, as I alluded to earlier. Interesting, when you look at the August number, revised 6.9%. How much lower can house price inflation go if we're sitting at 4.4%, Ewald?
Eleni, on a year-on-year basis, house prices can definitely go below the zero line again. I think it's a very real possibility that we will see real house price deflation very soon. We're already at 1% on a real basis, and we will definitely, the possibility is definitely there that we'll go back into sort of a technical recession from a property perspective.
And then that would be the optimum time to buy, surely.
Again, as David said, it's definitely an opportunity. These stats talk about a national picture.
Let's look at the interest rate environment. MPC rate decisions this year really surprised the market.
You know, the interest rates have obviously filtered through. We've had many drops this year already. And interest rates are such a significant factor when it comes to purchasing any type of property. So I certainly can see that we're going to see those interest rates driving property acquisition through the year, and the rates are likely to drop a little bit further. If we look at the European markets, though, we can see that house prices are continuing to decline there despite the very low interest rates. But I think we need to look at where the South African market was placed relative to the global markets, and we see there that we have been least affected because our house prices are lower comparative to those in Europe.
Okay, overall, looking forward, what can investors expect? I mean, we've also got perhaps a seasonal impact that we'll see as we head towards the end of the year, Ewald.
Eleni, we ask our estate agents in the market every quarter we do a survey, and they still say that properties on average on a national basis spends 15 weeks and 4 days on the market, which is an exceptionally long period compared to what we've seen a couple of years ago. So hopefully we can get that under about 3 months still, with the pricing realism getting in there, and some more stimulus from interest rate cutting will definitely assist the market in getting back on track.
Well, David, given the fact that you're on the pulse of the market, what kind of trends have you seen emerge? You know, it's easy to look at the numbers, but you're actually involved.
You know, it's very easy to look at the numbers, but one thing we need to remember is that property is a long-term investment. This is not a stock you trade out of in 24 hours. And if one looks at the market and you say, right, the market may show declines of X, Y, Z over the next year, but comparatively, it's a phenomenally good time to buy now, because within a 5-year framework, you're certainly going to see value appreciation in those properties if the current trends continue.
I think a very important point that Ewald mentioned, household debt to disposable income, still at very high levels. We're sitting at 78%. But at the end of the day, the interest rate cuts that we've seen, and of course interest rates at 30-year lows, have assisted us to have more money in our pockets, and in other words, we can afford our bonds far better. If that cycle turns, and it will eventually turn, surely consumers also need to start considering how they're going to cope with that when it comes to the fore. David?
Absolutely. Obviously one can fix your bond, your mortgage debt payments currently, and there are various mechanisms that one can look at. So if you are concerned about increases in interest rates coming through in time to come, that is certainly an option that one can consider, because through that mechanism you can ensure the security. So if your bond payment is affordable at a particular level, then you know that despite any interest rates that come through increases, that you will be able to maintain that debt level on the bond.
Let's just touch on the rental market very quickly, because that's a very different scenario that is playing out, Ewald. Do you think that it's going to continue down the line?
Currently, again from our estate agents, we see that properties being bought for letting purposes, or the buy-to-let market is definitely not topical for residential investors. We're only seeing that about 7% of new purchases are for rental purposes, and that's because the yields are currently so low on residential property itself. We're looking at about a 7.8% gross yield, which is a very simple calculation for gross yield, but it's definitely not where we want it to be. So a lot of the current investors are withdrawing their properties or selling their properties, and there's a demand for housing. So as people enter the market, they might want to enter the rental market, and as a balance shift, I foresee that that rental yields will start going up and property will become a bit more attractive.
And I think, just looking at the inflationary environment, we're sitting at an inflation rate of 3.2%, and any savvy investor will say that if you want, you obviously have to beat inflation so that you do make return on your money. The question is, are we going to see that down the line as well in South Africa with property prices? Do you think we could see a robust recovery, David?
Of property prices? Robust is an intangible word, but certainly we're going to see a recovery. And
growth of what percentage down the line?
If you look at the lower end of the market, if you look at properties up to about 600,000, it's not inconceivable that you could see 10 or 20% growth per annum on those types of properties. But you're not going to see that at the top end of the market, and then it becomes very subjective. Is it a Western Seaboard property in Cape Town, or is it in the south of Johannesburg? Both of which are great areas, but there's different market forces which drive either of those. So to say it's going to be robust growth, I'm not so sure.
When will it be robust growth, if at all, Ewald? The heydays of 2006, 2007.
Yes, well, I think what happened then was we were at extremely low credit levels with a very high interest rate, and as interest rates came down, we were able to grow the our credit extension quite a bit. And with high levels of credit on a national basis, obviously there's opportunities in segments, but we're going to have to bring that overall credit level down before we'll be able to grow that and bring the demand back to property.
Ewald, David, thank you very much for your time. Unfortunately, we have to leave it there.